All right, so let's get started. So it's really great to have Tim Roughgarden here today as our distinguished lecturer. Tim got his PhD at Cornell in 2002, doing some of the very early work on algorithmic game theory, especially in the context of network routing. If you were in my class this quarter, you saw some of his thesis work. From Cornell, he then did a postdoc at Berkeley and then going to Stanford, where he was a faculty member for many years, becoming a full professor there. At some point, he got tired of the balmy weather at Stanford and decided to move to Columbia. I think it was 2019, and has been at Columbia since then. Tim is also founding head of research at A16Z Crypto. Tim's research spans a wide range of areas in algorithmic economics, algorithmic mechanism design, some learning theory, general algorithm design, and a variety of areas related to all of those. Let's see. He's recipient of the Gödel Prize, the Collide Prize in Computer Science and Game Theory, the NSF P-Case Award, and the ACM Grace Murray Hopper Award. Among others, he's also a fellow of the ACM. And he's also written and edited a number of great books in algorithmic game theory and non-worst case analysis of algorithms and algorithms in general. And it's great.
All right, morning everybody. Thanks very much for coming. Haven't been at TTIC for maybe 5 years or so. Always glad to be back. I always enjoy my visits here. Always love being introduced by Avram, who's one of my longest and most consistent supporters, now like 25 years or so. So it's just a very cool full circle. Avram told you about some of the things I've worked on. Today I'm going to tell you about something completely different. I want to talk about a hard computer science problem. So some computing functionality that I think would be really cool to have. And then some of the, I think, really interesting scientific and engineering challenges that come up when you try to realize that functionality. For an analogy, like you could imagine 60 years ago, having a vision of a technology that would enable any two people on the globe to communicate digitally almost instantaneously. You could view today's internet as some kind of approximate realization of that vision. And if we think about the internet as sort of a neutral infrastructure for communication, neutral here meaning there's no one owner or operator of the internet, kind of what I want is the computational analog. So a neutral infrastructure for general purpose computation. So the functionality I want to think about realizing is really just that of a general purpose computer. A computer that has its own processor, its own operating system, its own memory. But unlike a typical computer, which would be owned by an individual or a corporation or someone who has like root access to that computer, I want to somehow build a computer that has none of those properties. That in some sense is not owned or operated by anybody in the same sense that the internet is not owned or operated by anybody. I want to think about this computer as almost just running by itself, like as a public good, kind of in the sky, if you will, where we can all watch its computations. I want the computer to be as resilient as possible. I want turning off this computer to be as hard as turning off the internet. And I want it to be open access. I want anybody to be able to use it. By use it, I mean maybe you install some software right on this computer's operating system, or maybe you're just using the computer, either its operating system or other user-installed computers on it. Okay, so that's what I'm going to mean by computer in the sky. And as I said, this talk, I'm going to focus on sort of core computer science questions in building out this functionality. Another question, of course, you could ask is like, why would you do this? If I gave you this technology on a silver platter, what would you use it for? Happy to talk about that at length after the talk. That's not the focus of the talk. Let me just sort of mention one slide about it. There's a bunch of different ways I could answer this question, honestly. Let me pick one way, which I think emphasizes a sort of under-discussed aspect of this technology. And in particular, like if you remember just one thing from this talk, I want you to remember that sort of, blockchains, Web3, et cetera, all this technology stack is not fundamentally about cryptocurrencies. It's not fundamentally about prices or about finance. It's really about something that, in my opinion, is much more profound, which is stronger notions of ownership for things that we buy or create in the digital realm. So let me explain what I mean. So let's start with a gift given to us now almost a half century ago by public key cryptography. Specifically, I'm talking about secure digital signatures. Because I would argue that you sort of think of secure digital signatures as allowing individuals to own, in a meaningful sense, a bit string, let's say 512 bits, representing a public key. And here by own, I mean you have knowledge of the corresponding private key. So what do I mean? Well, let's think of an analogy to the physical world. Like think about like real estate or something. Like suppose you buy a house. Right? So that affords you various property rights, right? Like one would be the right to use. Okay? If you bought the house, you get to live in it, no one can stop you. Let's think about the cryptographic keys, cryptographic guarantees of digital signatures, right? Well, if you're the owner of a public key, right, meaning you know the corresponding private key, you can create signatures. Nobody can stop you. Back to the house, right, another property right would be the right to exclude. No one else can live in your house unless you give them permission. Same thing with digital signatures, right? No one can forge signatures on your behalf if they don't own it. That's sort of your right alone. Okay, so that's a notion of ownership of 512-bit strings. Going back to the computer in the sky, which again, remember, is supposed to be a general purpose computer, certainly capable of attesting the ownership in this sense, capable of verifying digital signatures. Well, now it's kind of trivial to allow individuals to own arbitrary pieces of digital data, X, stored on this computer in the sky. What's the idea? You just allow programs running on this computer, maybe it's native operating system, maybe a user installed program running within that operating system, to create pairs, right? Arbitrary data X associated with a public key PK. And we can define ownership of arbitrary data X through inheritance through the definition we already have of the public key. Meaning the owner of this arbitrary digital data X is someone capable of producing a signature verifiable under the associated public key PK. So at this point, you should say like, okay, I guess there's this sense in which I can own data on this computer that runs in the sky, but like, why is that interesting? Like, how is that helpful to me? And there's a lot of different reasons, but I mean, high level, it's interesting to own something on this computer in the sky if it lets you do something you could not already do. Maybe it lets you do something on the computer in the sky you couldn't otherwise do. Maybe you can interact with other programs on that computer in a way you couldn't otherwise. Maybe you can exchange some data X that you own on that computer for some other data Y that you would like to. Or maybe owning data on this computer in the sky allows you to do things in the physical world you couldn't otherwise do. Like a trivial example would be X representing some kind of digital membership card that, I don't know, gets you to cool parties or something like that. Or more generally, maybe ownership of X, as attested to by this computer, is some kind of authentication, okay? Some notion of authenticity that perhaps you're someone from whose content should be trusted, as opposed to other sources which perhaps should not be trusted. But the high-level point of all this discussion I want you to have is just once you have the right mental model for what this technology is capable of doing, sort of this superpower of giving you stronger notions of ownership, arbitrary digital data, all of a sudden it becomes very easy to think about things you might do with this functionality. Okay, we've already seen several applications realized. I think we'll see many more realized over the next, call it 10 to 20 years or so. All right, so let me move now on to how would you build this out? And I want to talk about three different challenges that my recent work has focused on. I've optimized the talk for breadth over depth, so I'll talk about three different things. I'll necessarily have to be quite shallow on all three of them, but this should give you a sense of some of the challenges involved. In the first part, I want to drill down on this open access property that I want of this computer in the sky. Okay? In particular, how do we keep it economically sustainable when demand exceeds supply? Okay, that's going to bring us to the component of a blockchain protocol known as the transaction fee mechanism. So for this part of the talk, blockchain protocols, which is what this computer in the sky is approximately realized by, you don't have to know much about how they work. Okay, just fundamentally, what is a blockchain protocol doing? It's maintaining a running sequence of transactions. What's a transaction? Think of a transaction as like a little snippet of an assembly language. Okay, so by a sequence of transactions, really just mean a long sequence of assembly code instructions which are being executed in this computer in the sky, in this virtual machine. Okay? So transactions are added to this running log in batches. These batches are known as blocks. And all that matters for us right now is that these blocks are only so big and they're only produced every so often. Okay, and the second biggest blockchain that's out there, Ethereum, which is also the biggest general purpose smart contract platform, you'll see why I use it as a running example as we go through. For example, in the Ethereum blockchain protocol, there's one new block every 12 seconds, and a typical block might have, say, 200 transactions in it. And if that sounds like it's not that much computational power, that's because it's not that much computational power. Okay, that's like 15 to 20 transactions per second, something of that nature. And for a popular blockchain protocol like Ethereum or Bitcoin would also be in this category, the demand far outstrips that supply. There are many, many more than 15 to 20 transactions per second that would enjoy the privilege of being executed by the Ethereum blockchain protocol. Okay? So whether it likes it or not, a blockchain protocol is going to have to make allocation decisions. Some transactions are going to get in, some are not. It has to decide which ones get in and what they should pay. So that brings us to transaction fee mechanisms. What would one of these look like? Well, let me tell you about how it's worked in Bitcoin for the entire 15 years of its existence. Also how it worked in Ethereum until something like 2.5 years ago. Okay, something called the first price auction. Intuitively, if we want to take seriously this computer in the sky as a public good, we want it to be fully utilized. We want it to be utilized by the most valuable transactions. How is it supposed to know which transactions are the most valuable ones? Well, you ask users to report how much they value them. Okay, so along with a transaction submitted to a blockchain protocol, you have to submit a bid. The user submits a bid. How much they'd be willing to pay should that transaction be chosen for processing. Okay. These batches or blocks are added to the running log by block producers sampled at random. They think of them as just winning a lottery. So a single entity is designated to assemble the next block of 200 transactions. And of those 200 transactions that get included, okay, the bids of the 200 users that submitted them all then get transferred to that block producer. Okay, that is the recipient of those payments. So that's what I mean by a first price auction. Users submit bids with their transactions. Transactions get packaged into blocks by block producers. Those bids get transferred from the users to whoever put that block together. That's what I mean by a first price auction. If you've studied a little bit of auction theory, you know that first price auctions, like they have their positive aspects to it, but there's also a very obvious negative aspect, which is it's quite difficult often to figure out how you should bid in a first price auction. We've known this forever. Being on a blockchain certainly doesn't make it any easier. You never want to bid your maximum willingness to pay. That would be silly, because then you'd be indifferent between winning and losing. You want to bid less than your maximum willingness to pay. How much do you want to shade your bid? Kind of depends on how stiff the competition there it is. How many other people there are, how badly they want it. You have to reason about your competition to reason about how to bid in a first price auction. Some of you may know there are other auction mechanisms which do not have that property, but are much easier, so-called truthful mechanisms, like the second price or victory auction, where you just bid your maximum willingness to pay, you don't worry about anybody else, you know it's going to be optimal. So an obvious question then, with transaction fee mechanisms, is, can we improve over the first price auction? For example, can we make it easier for people to bid in? For example, can we make it as easy as it is to bid in a second price or victory auction? So that's the first question I want to think about. Hopefully this seems like a very basic question, right? Blockchain protocols have to make this fundamental allocation decision. How should you do it? For the specific case of the Ethereum protocol, this was also a very timely question at the time I did this work, which was in 2020. Because at that time, Ethereum was using a first price auction, what I just shown you. That was the incumbent. But there was also a challenger transaction fee mechanism which had been proposed, which I'll show it to you. It was very, very different. And they're considering whether or not to switch over this critical part of the protocol to this sort of new, mechanism. And opinions were split. Okay, some people loved it, some people hated it. Lots of people were just confused. Like, what is this new mechanism and what is it trying to achieve? And the Ethereum community really prides themselves on sort of like the tradition of open source software and sort of community-owned kind of technology. So they take that very seriously. So because this was polarizing, a key member of the community, Tim Byko, so again, this was in 2020, so he actually did a community outreach survey. So he talked to various stakeholders. He talked to like miners, this was back in the proof of work days, people who ran exchanges, people who ran wallet software, asked all these different people, how do you feel about this new transaction fee mechanism? And if you don't like it, what can we as a community do to make you feel more comfortable with switching over to it? Okay, so that led to this community outreach report. The new transaction fee mechanism is known as EIP 1559. EIP here stands for Ethereum Improvement Proposal. That's the mechanism by which they coordinate and sort of vet proposals for upgrading the protocol. Okay. And so there are a bunch of responses to this survey, but the one I want to highlight here was the lack of a formal specification or proof for the mechanism that people can independently evaluate and critique. And mind you, not a single respondent to the survey is someone who writes research papers. Okay? These are all people who are working in the trenches, trying to build stuff, trying to get Ethereum to work. And even among that kind of super practical group, there was this just kind of visceral hunger for the kind of work that I and other people in algorithmic game theory do. And sort of rigorous analysis of mechanism design questions that come up in computer science applications. So this obviously, was a big motivation for me to kind of do this work back in 2020. So what I want to do next is just answer the question, like, why isn't this already a well-solved problem? And this is a theme that's going to come up over and over again in all parts of this talk, right? We're going to have a problem. It seems like we already know how to solve this in other contexts. Why can't you copy-paste the solution? The answer every single time is going to be exactly the same, which is that sort of blockchain protocols, and in particular the permissionless environment in which they operate, just imposes these extra challenges that no one's ever thought about before. So classical theories like classical mechanism design will be useful to us, but we will have to supplement them in novel ways to speak to these applications. Okay? So why can we not just copy-paste some mechanism from a textbook to have a better transaction fee mechanism that's truthful, like an analog of the Vickery auction? So on this slide, I'm going to list the challenges, okay, which will force us to supplement the usual incentive compatibility notion we see in mechanism design with two new notions as well. Right? Challenge number 0, so this is the old notion, this has nothing to do with blockchain protocols. Whenever you're doing mechanism design, whenever you're asking people for their preferences and then making a decision based on what they tell you, you need to be worried that they're going to lie to you about what they actually want so that you compute a decision which is better for them than the one you would otherwise. So, but we have standard language for saying we want mechanisms to be robust to gaming of this form. They're called truthful mechanisms or DSIC mechanisms. DSIC here is dominant strategy incentive compatible. Okay, so this just means there's no reason that users want to misrepresent what it is that they want. For example, truthful bidding in an auction. Let me tell you about the two new types of incentive compatibility constraints we're going to need, things that are really kind of unusual about this blockchain context. First, remember back when I said how batches of transactions get added to the running log, right? I said a block producer is chosen uniformly at random, or at random using a lottery, and then they get to put together the batch of the next 200 transactions. Okay. So there's this brief moment in time where that randomly sampled block producer actually has full unilateral control over the next 200 transactions that get added to the log. They can include whatever they want, they can exclude whatever they want, they can make up their own fake transactions and put those in as well, they can do whatever they want. Unilateral control over those 200 transactions. And so that means if you're sort of an analyst trying to come up with a mechanism that you would like these block producers to use, it's all fine to kind of like write something down and like prove all these nice properties. But the question is, like, is the block producer actually going to be motivated to do it? Okay? And so that's going to lead us to this second notion of incentive compatibility, MMIC, which says whatever transaction fee mechanism you write down and ask them to use, it should be in the interest of the block producers to use it. It should maximize their profit to follow your mechanism rather than deviating it from any way. And then the last challenge is going to be collusion is a much bigger concern in a blockchain context than it is in more traditional applications, right? Like, if you're kind of the US government, running a combinatorial auction to sell sort of spectrum licenses, right, what do? You just have everybody sort of, the participants in your auction, you have them sign sort of a legal binding contract stating that they won't collude, and you persecute people if they do collude. That's kind of how you handle collusion traditionally, outside of the mechanism, right? Whereas, in a blockchain context, this thing is happening every 12 seconds, and you don't have that much information about who's participating in the auction. That's just not going to work. You really want mechanisms that are intrinsically robust to collusion. Okay, so you might be worried about users colluding with each other. As I'll say in a second, we're also worried about users colluding with the block producer. Okay, so our third incentive compatibility notion is going to be OCA proofness. OCA here stands for off-chain agreement. Again, high level, this means users should be motivated to do what you want them to do. This means block producers should be motivated to do what you want them to do. And this should be, moreover, they don't want to collude. That's what these three constraints. And then the key question of this part of the talk is, can we meet all three guarantees simultaneously? The next two slides have sort of more formal definitions of the two new incentive compatibility notions, MMIC and OCA proof. I'm not going to talk through these in detail. They're really the definitions. Given what I've told you in English, this is what any of you would write down. So there wouldn't be any surprises. What I do want to highlight is each of these two new notions does rule out one type of solution you would be tempted to copy-paste from a textbook. I just want you to see the details of how that happens. So MMIC, so remember this says it should be in the block producer's interest to do what you want them to do. Okay? Suppose you tried to run a second price auction, okay? Right, where you say, hey, include the top one and charge them the second highest bid, right? From the block producer's perspective, right, they know all of the pending transactions from which they can pick however many, 200 or whatever, and then moreover, they can insert any of their own transactions on top of it. Which means, if you think about a second price auction, let's say it was just like one item, all of a sudden, as the sort of mechanism, the person running the mechanism, you're like, high bid was $10, second highest bid was $8. Maybe I'll just insert my own bid for $9.99. What does that do? That forces the winner to basically pay their bid, okay, as opposed to what was the real second bid. So shill bids, if you have a seller who can insert shill bids after seeing all of the real bids, a second price auction devolves into a first price auction anyways. Okay? So this is what rules out second price auctions or the BCG mechanism for those of you. This is why you basically never hear about Vickrey auctions in a blockchain context. Worrying about collusion rules out a different format you'd be tempted to copy paste, which is using reserve prices, at least using reserve prices in the most obvious way. Right? Suppose you said like, hey, I want there to be a $10 reserve price so that transactions are only eligible if they bid $10 or more. So that's what you'd like the block producer to do. But now suppose in reality, right, there's all these pending transactions, they'll all be willing to pay $7, nobody's willing to pay $10, right? The block producer is then motivated to say, hey, everybody, look, just bid $10 on chain, like officially bid $10 so that you're eligible, and I'll refund you $3.50 off chain. Okay? And we'll all be better off. Okay? All get paid, you'll get your transactions in, you'll have some value for your transactions. Everybody's better off with this collusive agreement. Okay? So those are two of the roles that these incentive compatibility constraints. All right, so back to the story in Ethereum. We have our incumbent, first price auctions, where users just pay their bids to the block producer. And then I said there was a challenger, EIP 1559. Okay? And we now have the language to assess whether or not it's an improvement. We have these three notions of incentive compatibility. So let me tell you about the challenger mechanism, and then we can see how well it does on our scorecard for these different incentive compatibility notions. Three big ideas, I would say, in EIP 1559. Okay? The first idea, which will sound crazy when I say it, is it has a reserve price, in this context called a base fee. But wait, you say, didn't I just say that OCA proofness, collusion, means you can't use reserve prices? I did say that. You can't use them in the obvious way, where money raised by the reserve price is passed on to the block producer. That's what introduces this incentive to collude. So EIP 1559 does something different. It actually burns all of the payments that are made to cover the reserve price, to cover the base fee. And by burn, I mean literally those coins are removed from circulation forever. Okay? So this is really taking advantage of the fact that this mechanism is operating in the context of a blockchain protocol that has its own native currency, namely ETH. So it is in a position to print it, it is in a position to burn it, and that is part of the mechanism's description. All right, so there's going to be a reserve price or a base fee. Money spent to pay the base fee just gets burned. Second big change is rather than just having this hard cap of 200 transactions per block, we're going to make that a soft capacity instead. So there will still be a target, still like on average 200 transactions per block, but we're going to allow to go over that if there's a reason to. Okay, let's still cap it. Let's say you go up to 400 transactions at the most. Now, why do we do this? A couple reasons, but the main reason is, right, I tell you there's a reserve price, but you should have asked the question, it's like, but what's the reserve price? How is the protocol supposed to know whether it's $1 or $10 or $100? Like, what should it be? Okay? And now it's going to leverage the fact that one of these auctions is being run every 12 seconds. And it's going to use the outcomes of previous auctions to inform the reserve price of the next one, okay? Using local search. If the last reserve price looked too high, you lower it a little bit, and vice versa. How do you know whether the last reserve price was too high or too low? You look at how big the block was. Again, we have a target of 200, that's what you're shooting for. We're willing to go up to 400. So if you see a block that had only 100 transactions in it, less than the target of 200, well, that seems like we're pricing it too high. Okay, so in the next auction, we're going to lower the base fee a bit. If we see a block that has 300 transactions in it, then it seems like we're selling it too cheaply, because that's above our target of 200, so then we'll raise it for the next auction. Okay? So these two things are tightly coupled. Block sizes can be bigger or smaller, and that is exactly the feedback that's used to tune this sort of local search for the right value of the base fee. Finally, there's kind of an emergency backup first price auction built into it. So just so that in the worst case, it can revert to a first price auction if it really needs to. So the way this works is, as a user, you always have to pay the reserve price, you always have to pay the base fee. Optionally, you can pay more than that, in this context called the tip, and whatever you pay above and beyond the reserve price is treated like a bid back in the first price auction. So that actually does get transferred directly to the block producer. Okay. All right. So those are the three parts of EIP 1559, and this was designed by Vitalik Buterin, who's also one of the co-founders of Ethereum. Okay. All right, so now we have three dimensions along which to assess these transaction fee mechanisms. We have our three notions of incentive compatibility, we have a challenger, we have our incumbents, so we can actually sort of try to make an apples to apples comparison. Let's start with the incumbent, first price auctions. They're definitely not truthful, we know that. You always shade your bid. They're pretty much never truthful under any conditions. Pretty easy to check that they satisfy the two other incentive compatibility constraints, right? Which is probably not an accident. That's probably why it's done so well for over a decade. Okay. So basically it tells the block producer, hey, you should choose the transactions that'll maximize your revenue. And the block producer's like, cool, happy to do that. And then same thing, OCA proofness, it satisfies that as well. And here, like, what's frustrating about first price auctions is it's not like you need a blockchain environment to think of using this mechanism. You could imagine using this mechanism for all kinds of different allocation problems and all kinds of different domains. Whereas EIP 1559, right, the challenger, you would never think about this. I don't even know if this mechanism makes sense outside of the blockchain context. You're taking advantage of the fact that you have a native cryptocurrency that you could burn if you want. And you're taking advantage of the fact that one of these happens every 12 seconds to do local search on this reserve price. So you're really taking advantage of the idiosyncratic things you have going for you in the blockchain setting, and in exchange, you do indeed get a Pareto improvement in the incentive compatibility guarantees. Like the first price auction, you are always MMIC, always OCA proof. It's a little less trivial to see this, but still not too hard to see. And unlike the first price auction, which is basically never truthful, the EIP 1559 is usually truthful. It's truthful outside of one edge case, which is when, for whatever reason, the base fee is like way too low. If you think about it, if the base fee is 0, which is never going to be, but like in principle, if the base fee was 0, EIP 1559 would literally be identical to a first price auction, if you think about it. So the first price auction isn't truthful, neither is EIP 1559 when you have a 0 base fee. And more generally, that's the only situation in which truthfulness goes wrong in EIP 1559. When the base fee is so low that more than 400 transactions would be willing to pay. Okay. And remember, you're targeting 200 transactions. So that says you're way off if more than 400 are willing to pay. Okay? So given that you're constantly doing this sort of local search to adjust the base fee, it's relatively infrequent that you're in this edge case in EIP 1559. Okay? So that's what I mean by Pareto improvement. Okay? So the two things you had before, you have again, and the thing which you used to never have, you now usually have. Okay? I also suggested a variant of the mechanism, which allows you to move the usually from here to here. So it's called the tipless mechanism, always MMIC, always truthful, usually OCA proofness. OCA proofness breaks down in exactly the same edge case where the base fee is way too low. Okay. Of course, you always want to be greedy as a researcher. You always want to do better. What's up with these usuallys? Unfortunately, you got to have the usually. Okay, so a paper that just came out earlier this year is an impossibility result, which says actually it is impossible to at all times get all three of these incentive compatibility notions. You need to make some kind of compromise. So in that sense, both EIP 1559 and the variant I suggested are sort of on the Pareto frontier of what you can achieve incentive compatibly with a transaction fee mechanism. There's a question?
That was my question.
Okay, great. There's sort of three themes, so as I go through these three topics kind of very, very quickly, maybe three themes I want you to look out for. The first theme we've already seen, which is that just the unique constraints of the blockchain, sort of the permissionless setting, force us to revisit what would seem to be well-solved problems from first principles. And classic theories really need to be supplemented with new ideas. We've seen one example, we'll see two more. Theme number two I want you to look out for is just how multidisciplinary work in this area is. And I say that as someone who's kind of done interdisciplinary work most of his career, but work around kind of blockchains and Web3 takes it to a different level. Right? Even the different parts of computer science that this area touches on have historically had nothing to do with each other. even the different parts of economics that are relevant for this technology have historically had nothing to do with each other. And then there's fields outside of computer science and economics that you're not going to see in this talk, but are also quite relevant. So that's theme number 2, all the disciplines involved. Theme number 3 is the very, very short pipeline from just kind of pure theoretical work to practical impact. That pipeline is probably maybe as short as I've ever seen it in my career. And it's been actually quite wild working in this area for the last few years. So I'll tell you a couple anecdotes about that going along the way. So I released my sort of public report, not the research paper, but just kind of a report for the public on December 1st, 2020, with my analysis of the EFP 1559. Same day, the Ethereum folks we've been hearing from, Vitalik Buterin and Tim Biko, right, among many others, we're already sort of excited about it. Fast forward about 8 months later, and actually this transaction fee mechanism did get deployed. Okay, so the community did sort of coalesce around this being a positive improvement to Ethereum. So they did what's called a hard fork, which is basically a coordinated protocol upgrade. And as that hard fork grew close, there were lots of articles just telling people what you should expect, what problems kind of does it solve, what problems does it not solve. My report was kind of the standard reference people use to explain that to the broader public. And now it's pretty cute. People even have like these dashboards, which are kind of like tracking how much ETH have been burned to date since the switch over to this transaction fee mechanism. Right, so it's kind of just a very, at this point, fundamental and well-loved component, I would say, of the Ethereum protocol. So that was all about keeping the computer in the sky open access, and economically sustainable. What I want to do next is drill down on what I mean by it having sort of no operator. What does that actually mean? And what it actually means is it's not going to be a physical computer the way this laptop is a physical computer. Okay, it's going to be a virtual computer, a virtual machine. And there are going to be lots of nodes, ideally thousands of nodes scattered across the globe that are going to be coordinating on the current states of this virtual machine, like exactly which assembly line instructions have been executed to date. Okay. So, we have, so what is it that keeps a bunch of nodes in sync on the state of something? That's something called a consensus protocol. That is a very classic topic in computer science dating back to the 1980s. A couple Turing awards have been given out around pioneering work on consensus protocols. Like with mechanism design, we will build on the existing theory, we'll stand on the shoulders of giants, but we'll also see that we have to supplement the existing theory in multiple ways. This is going to be joint work with Andrew Lewis Pye, who's a professor at London School of Economics. This is actually the longest research paper I've ever co-authored, 75 pages. I know there's multiple people in the room for which that's not that long, but for me that's quite long. So, and these days, every time I release a new paper, I generally also kind of release like a tweet storm, just sort of like summarizing it. And I know on the one hand, this is kind of like a silly gimmick. On the other hand, it's clearly been like so useful to people, right? Like we often talk about how we go to academic conferences and like the most useful thing there was like the quarter conversations that you have. These are the quarter conversations, right? Just made available to everybody. Kind of seems like a good thing. Anyways, this is the only paper I've done that's so long I had to do a recursive tweet storms with 100 leaves at the bottom, but still a lot faster than reading the paper. So we want to keep a bunch of nodes in sync on the state of something. In our case, on the state of the virtual machine that corresponds to, say, the Ethereum protocol. The minimal requirements you would ever want of a consensus protocol is you want liveness, you'd want consistency. Liveness, meaning as long as there's work to be done, it should get done. If there's transactions pending, we want to see transactions getting processed by the blockchain protocol. Consistency meaning nobody should ever disagree. All of these nodes should sort of, no one should disagree on which instructions have been processed up to this point. Okay. Why is this not a trivial problem? What makes this hard? Well, traditionally, the two big challenges have been, first of all, some nodes may run the protocol incorrectly. Who knows why, right? Maybe there's a power outage and they went offline. Maybe they've got buggy software. Maybe even that node got hijacked by someone that really wants to mess up your protocol. Who knows? The other challenge is the communication network the nodes are using to send messages to each other. It might be having a good day, it might be having a bad day. It's hard to know. Hard to know exactly how much messages are going to be delayed when you're running one of these protocols. And I think one of the big reasons why this theory has been so successful, there's this really rich, beautiful literature with consensus protocols over the last 40 years. I think one of the reasons it's gone so well is that the pioneers back in the 1980s, they set up this great playground for theoreticians to just play in for a long time. And one of the things they did is they took these two challenges, faulty nodes, unreliable communication network, And they parameterize those challenges, okay, using hierarchies of weaker and stronger versions of those assumptions, which just kind of give like ladders for researchers to kind of climb, right, for better positive results or sort of more impressive impossibility results. Faults, for example, there's like the most benign type of fault, which is that the computer just crashes, you never hear from them again. There's the kind of expert level, there's the very hard type of fault, Byzantine faults, where you basically assume some malicious nation state has the node and is just trying to bring it down. Okay. Same thing with the communication network, right? The most benign model is that there's some bound on how long it takes messages to be delivered. I don't know, a second, 5 seconds, whatever. Intermediate model, partially synchronous model, you allow periodic disruptions, like periodic denial of service attacks of some bounded duration. And then here, expert level would be the asynchronous model, where you assume nothing about message delivery other than everything is delivered eventually. So that's all the sort of classic models from the 1980s. Yet again, right, so we need a consensus protocol here to realize this ownerless kind of general purpose computer, but we're working in this sort of very different environment, permissionless environment. For example, right, you or I today, right after this talk, we could spin up a Bitcoin node and contribute to running the Bitcoin protocol, even though it was launched 15 years ago. Protocol doesn't care. Okay? None of the protocols from the 20th century were written out. That's not what they were shooting for. Okay? So here we really want consensus protocols where you do not know who's going to be running it at the time you deploy the protocol. Okay? Another issue is that you don't really know who the people are running the protocol. And in particular, for all you know, there's one entity that's masquerading as 1,000 entities using different identifiers. So this is the Sybil problem. If you've ever heard of like proof of work or proof of stake, those are ways of addressing the Sybil problem. What I want to focus on today is this third one, which is that ideally it should be fine if there are nodes which periodically go offline. All right, so again, you or I could sort of start contributing to the Bitcoin protocol right now, today. Maybe we go away for the weekend, right? We just turn off our computers over the weekend, turn them back on Monday morning, right? And the hope would be that that's fine, right? As long as everybody contributing to the protocol isn't trying to mess it up, you'd like the protocol to still function as intended. And so this is the challenge that in the same spirit of hierarchies of faults, hierarchies of communication, unreliability, I'm going to introduce on the next slide a hierarchy of what kind of activity you can assume, or we allow a protocol to assume, of the honest nodes that are running. So we're going to have the hierarchy on this slide. The hierarchy is going to have 4 levels. At the top is going to be the weakest assumptions. So that's going to be the most demanding for protocol design. It's where you're most likely to see impossibility results. As we go from the top of the slide down to the bottom, we're going to allow a protocol to make stronger and stronger assumptions about the honest players that are running the protocol. And so we're hoping for more and more positive results as we go down this slide. Top level of the hierarchy, which we call the fully permissionless or FP setting, we assume literally nothing. Every moment in time, the consensus protocol has literally no idea of even a single person who might be running. Which in 2008, if you'd said that, I think almost anyone would have been like, yeah, clearly that's just a ridiculous model where you couldn't possibly do anything. The Bitcoin protocol, under not crazy assumptions, actually provably functions correctly in the fully permissionless model, which to this day is like kind of amazing, actually. Okay. So that's the FP model, most demanding, where you don't assume anything, literally anything, about who's running the protocol. The next level, the dynamically available or DA setting, we assume a little bit more. Okay. The protocol is aware of a current list of identifiers. Okay. And if you know a little bit about kind of blockchains, think of this list of identifiers as being users who have locked up stake in escrow in a proof of stake protocol. That would be the canonical interpretation of this list of identifiers. So the protocol is aware of these identifiers. The protocol in the DA setting is not aware of exactly which ones of these identifiers are away for the weekend and which ones are actively running the protocol. Okay? So that's what you don't know in the DA setting. So membership in this list is a necessary condition for participation. The only relevant users are the ones with their IDs in this list, but it's not sufficient. You really don't know which subset of those users are active at any given moment. And proof of stake, longest chain protocols are in hindsight, kind of thought to, designed to operate in this setting. Third level, we call the quasi-permissionless or QP setting. So we again have this list of identifiers, like people with stake locked up in escrow, But here we're going to make the stronger assumption that membership in the list is not only necessary, but also sufficient for participation. In other words, the protocol is allowed to assume that any identifier in this list controlled by an honest player is in fact online and operating the protocol correctly at that time. No one has gone away for the weekend. Everybody got sort of sitters to babysit their nodes over the weekend. Okay? And there are certain types of blockchain protocols, especially proof-of-stake ones, based on 20th century protocols like PBFT. Would be one of those 20th century protocols that, again, in hindsight, we can interpret as being built to run in this setting. Okay. And then there's the traditional 20th century model where just like you literally know all the nodes that are going to be running your protocol at the time you deploy it. They're kind of hardwired into the protocol's description, in effect. Okay. So in our paper, we prove strict separations between all 4 levels. Okay, so at each of these levels, there's things you can do that you provably cannot do at the level above. It seems to us that by far the biggest chasm is between the middle 2 levels. So the one thing I want to tell you a little bit about is just some color on the chasm here. Things that you cannot do here that you can do here. All right, so let's start with the impossibility results. So we're going to make the weaker assumption, because the protocol has this list, but doesn't know exactly who on that list is away for the weekend versus in town and running their machine. And I'm going to tell you 3 things you would actually really like a consensus protocol to have on top of, above and beyond consistency and liveness. 3 things you'd like them to have that you provably cannot have in the DA setting. Okay. So the first one is that if you're subject to denial of service attacks, so if you're in the partially synchronous model, so you might sometimes have delay bounds that you can't really know about a priori, there's no choice but to suffer consistency violations. Okay. So you cannot have consistency and liveness both if you have, for example, denial of service attacks. So that's sort of a bummer, right? Property 2, a nice property called accountability, which says that whenever something goes wrong with your protocol, so if 2 nodes do get out of sync, there's a smoking gun. Okay, you can identify the perpetrator as responsible for the fact that there was a consistency violation, the fact that 2 nodes went out of sync. Okay. That is a second property you provably cannot have in the DA setting. Property 3 is something known as optimistic responsiveness. This you can think of as like an instance optimal version of liveness. Right? So liveness just says as long as there's work to be done, it should continue to get done. Optimistic responsiveness says, moreover, it should get done at network speed. So if the network suddenly 10x's, gets faster, you would like to see transactions get confirmed 10x faster as well. That's optimistic responsiveness. Also cannot have that in the DA setting. All of these you can have in the QP setting. So we design a single protocol. It's a proof-of-stake protocol. Obviously, you need some control on the size of the adversary. The adversary can't have full control of the protocol. The right sort of threshold here is you assume the adversary controls less than 1/3 of the overall stake. So it's a single proof-of-stake protocol that has all 3 of those properties. Okay. So you get consistency no matter what. Doesn't matter how screwed up the network is. Nodes will never go out of sync. You can have accountability. If there is a consistency violation, why would you have a consistency violation? It would only be if this hypothesis was violated. If there was a consistency violation, you could figure out who was responsible for it, potentially punish them later. And you can also progress at network speed. Okay. And so that's what I mean by the chasm between D and QP. There are also separations between the other levels as well. They're not, at least according to our results thus far, they're not as stark. Okay. Lots of other results in the paper I won't have time to talk about. I mean, I will say, we would love it if 10 years from now people think of the main contribution of the paper as being the model. Okay, we hope that we have given the model, which should be the canonical one for reasoning about permissionless consensus protocols. We have a lot of results in our paper. Yeah, we like the results too, but a lot of it is just to prove the point that the model is very versatile and allows you to actually formally say all of these different things. So we're hoping lots of other researchers follow up on this. We just released our own first follow-up paper. This just came out last week, also with Eric Budish, who's down the street at Chicago in the business school, which is the first rigorous analysis of slashing. So slashing is a technique in proof-of-stake protocols. It's actually implemented in today's Ethereum protocol, which is basically when someone attacks the protocol, it's a way for the protocol to fight back and ideally confiscate stake from the attackers. This is the first actually rigorous analysis of when, sort of under what assumptions this can be made to work. And really, I think the only reason no one else wrote this paper previously is because no one really had the right model to prove it. So the permissionless consensus framework, we think, is the right one for that. All right, so for the last segment, I said sort of at the outset that I want you to remember this technology is not fundamentally about cryptocurrencies, not about prices, not about finance. all that said, there are some really interesting, just scientifically interesting market design problems arising at the application layer, okay, in decentralized finance. I want to just talk a little bit about my work there in this last part of the talk. Okay, this is joint work with Jason Milionis, who's my PhD student at Columbia, Simak Mollemi, who's my colleague in the Business School at Columbia, and Anthony Lee Zhang, who was also just down the street in the Business School at Chicago. So once you have ownership, like you get in the sky, once you have actual meaningful notions of ownership, you have notions of exchange, of trade of ownership, exchanging one thing for another, all right? A very, very trivial type of exchange would be you have a cryptocurrency, like say ETH, Ethereum's native currency. Maybe you want to trade that for a digital representation of the dollar. A stable coin like USDC would be the name of a popular stable coin. Right? Again, old problem, like anyone who sort of manages a stock portfolio, right, interacts with Schwab or whatever, like you're buying and selling shares of the stock for dollars, right? Seems like the same problem. What you see there, what you see in the New York Stock Exchange and all of most other exchanges is a limit order book. Okay? So why don't we just use a limit order book to trade cryptocurrencies? And maybe long term that will be the dominant way of doing it, but so far it has not been. Okay? And there's two reasons for that. And again, it's because of the peculiarities of the blockchain environment. The first is that at least for older generation blockchain protocols like Ethereum, limit order books are actually too computationally expensive. You got to like keep track of this possibly very long list of standing orders. You got to do this matching logic every time a new order shows up. We talked about how Ethereum is not that powerful a computer, right? And so this is a lot of work for it. There's a second reason also, which is that limit order books, including in the real world, right, work particularly well in thick markets where you have like lots of traders on both sides, right? To buy or sell in an order book, you need someone to take the other side of your trade. And a lot of the assets being traded, kind of in blockchain protocols, at least today, are thin markets. ETH USDC would be a thick market, but a lot of them are thin markets. And the worry would be you basically never have trade because you never have counterparties there at the same time in the right place. Okay? So those two reasons motivated a different design known as an automated market maker, or AMM. So an AMM is something, it's really just sort of a smart contract, lives in a blockchain protocol, so a program installed in the operating system on that computer in the sky, that's just sort of always ready for business. So an AMM at any given moment will quote you a spot price, $3,000 per ETH, something like that. It'll quote you a spot price. It's willing to take either side of a trade at that price. It'll buy, it'll sell, whatever. So in other words, the AMM itself will always act as your counterparty. So you can always trade with it. So it's really good for thin markets in that sense. Okay, but now your question is like, wait a minute, like if this is just some like random smart contract kind of really on this blockchain protocol, like why does it have any cryptocurrency at all? Like, where did it get it? Well, those are supplied by entities known as liquidity providers, or LPs. Okay, so these are individual entities that own cryptocurrency and deposit them into AMMs. Why do they do that? Because they earn a share of the trading fees. So this is a way to earn yield on digital assets that you own. All right, well, if I put it that way, like if you happen to own digital assets like this, why would you not put them in some AMM? Like, why would you not earn this yield on it? And so the answer to this question is not specific to blockchains or DeFi, just in general in market making. Always what you're worried about is something called adverse selection, right? Which is whenever you make an offer and then someone takes it, it should always be like a little alarm bell, like in the back of your head, right? Like, does this person know that I don't know? Right? You should always be a little nervous, right? And that's the adverse selection nervousness, right? And man, if it's an AMM on Ethereum, boy, sometimes people are going to know a lot more than you do, you being the AMM. Because what did I say? One new block every 12 seconds. Okay? 12-second window, and the state of the Ethereum virtual machine, including the current spot price on all the AMMs running on that virtual machine, stays exactly the same. Time is frozen for 12 seconds. Right? On the open markets, right, on Coinbase, Binance, whatever, the price of ETH is not frozen for 12 seconds. For example, if during that 12-second period the price of ETH goes up quite a bit, then, right, if you're lucky, maybe you get to be the person who buys a bunch of ETH from an AMM at its low stale price, turns it around, flips it on a centralized exchange at the current market price, pocketing the arbitrage profit. Okay? And that is profit that comes at the expense of the liquidity providers. Okay? So why would you want to provide liquidity? To get a share of the trading fees. Why would you not want to provide liquidity? Because you will be at the same time losing to arbitrageurs who are picking off these stale prices. Okay? So it's just a cost-benefit analysis, right? Whether you want to provide liquidity or not, right? You know what the benefits are, right? That's just fees. That's just going to be proportional volume, very easy to think about. And then the costs are these adverse selection costs. And was not really known, believe it or not, prior to this work, was the right way to think about these adverse selection costs. And fees are kind of trivial to think about. I'm going to show you what is now the industry standard for how to think about the costs to that cost benefit analysis. Okay. It's going to be a concept called lever. That's LVR, stands for loss versus rebalancing. I'm going to tell you two versions. One version is sort of more kind of for looking backward, taking it to data, asking like, was a particular LP decision a good idea or not? Then we'll look at a kind of more mathematical one, which is more to do prediction, sort of think about sort of future investments you might make. So here's the empirical one. So suppose you have a fixed AMM, and there's been a bunch of trades, and trades have happened. Let's say you sold AI, in the I trade you sold AI units of ETH. There's several definitions. Definition number one, let's just do the thought experiment. Let's just ask ourselves, suppose, we're a liquidity provider, suppose that rather than doing these trades we were forced to do by the AMM that we put our deposit into, suppose we did exactly the same trades, but we did them on the open market instead. How much better off would we have been? Okay? So AI here is the trade quantity, PI is the open market price, and then QI is the price that the AMM forced us to trade at. So for example, if we sold ETH and the AMM price was stale and low compared to the market price, that would contribute a positive amount to the level. I think that would be something we sort of regret that we missed out on, because we were forced to go through the AMM rather than using the open market. Okay, same thing if you were buying ETH and AI was negative, and then P would be less than Q in that case. So every trade contributes lever. It's just how much better off you would have been had you done the same trade on the open market. So very easy to compute, as you can tell. It's about as hard as like computing the volatility of an asset. Like I think there might even already be like first-year MBAs that kind of are computing this stuff in Excel spreadsheets and whatnot. Why is it a good definition? Well, it always helps if you're trying to sort of popularize a new definition to argue it can be viewed in multiple different ways. It seems to capture multiple things at the same time. So a couple trivial equivalences. So I define it as the outcome of this thought experiment, where instead you're using the open exchange. Alternatively, you can characterize it as the profits lost to arbitrageurs. Okay, so if you're an arbitrageur, and I give you the very generous scenario of kind of a centralized exchange where you have no price impact, so infinite depth, and I also waive all your trading fees, then actually lever is exactly going to be the arbitrage profit that you're getting. Again, this makes sense, right? We talked about sort of the adverse selection cost of the LP being like the flip side of the arbitrage profit. It's really a zero-sum game between those two. And so we're not surprised to see this characterization. Alternatively, you can think of lever as sort of being kind of something you can guarantee yourself. It's a tradable strategy in the sense that if you really, really want to deposit some of your funds into an AMM, but you're worried about market risk, like you're worried about the price of ETH doing weird things, while your stuff is locked up in this AMM, you can always, quote unquote, delta hedge your market risk. So you can have a symmetric position out on an open exchange. Whenever the AMM forces you to sell 5 ETH, you just buy 5 ETH to sort of counteract it on your sort of external position. And so if you delta hedge like that, then once you mod out by market risk, lever is sort of what's left. That's your residual losses once you've gotten rid of the market risk factor. So those are all ways to think about lever. And again, this is just to characterize the cost part of that cost benefit analysis. So, maybe more interesting would be like, well, let's sort of try to project out into the future, right? Should we actually deposit? Should we be a liquidity provider for some AMM or not? How should we think about that? Well, to do that, we need some opinion about how prices are going to evolve in the future, right? If we believe the price is never going to change again, well, then there's not going to be any arbitrage opportunities, and we should be fine. If we think the price is going to go crazy, we might be worried about arbitrage. We might think twice about it. Okay? So we need some model of how prices are going to evolve. You can plug in whatever model you want to here. For us, it seemed like the obvious one would be just the standard Black-Scholes model, where the price of the risky asset, like ETH, is just evolving according to geometric Brownian motion. If you don't know what this means, just think of this as like, in the log price space, you're doing a random walk. Okay? And if you've never seen this before, one thing to know, like there's really only one important parameter, which is the volatility sigma. Okay, so if sigma is 0, the price is always staying the same. If sigma is big, it's going crazy. Okay, think of sigma as kind of like the length of a random walk step if you're doing a random walk in log price. Okay, so now you can ask, what's lever going to be if prices evolve in this way? And we'd like a formula for that. We'd like as simple as interpretable formula as possible. It's going to have to depend on some stuff. It's going to have to depend on sigma. Again, if sigma is 0, presumably lever's 0, there's no arbitrage. If sigma is big, presumably lever's big. It's going to depend on the AMM, if you think about it. Because remember, we had the A times P minus Q. The Q's are defined by the AMM. That's the spot price of the AMM. And actually, it also induces what the A's are. It induces what the trade size is that corrects the spot price of the AMM. So we need these dependencies at a minimum. Subject to that, we'd like it to be as clean as possible. Here's the answer. Is this clean? It depends on the eye of the beholder. It depends on your prior. Let me talk through it a little bit. I'd like to argue this is basically about as clean as you could hope for. Remember, lever accumulates trade by trade. We've passed from a discrete to a continuous time model, right? So price is always evolving, so arbitrage is always happening. So that's why we're saying lever accumulate according to this integral from over 0 to t. Instantaneously, at any given moment in time, it's accumulating at a rate of -1/2 times quantity sigma times the current price quantity squared times the marginal liquidity times dx by dp. There's sigma. We knew it was going to show up. Here it is. Sigma squared, which is like a little unfortunate. It's like pretty big. We knew it had to depend on the AMM, but it does so only locally, only through this marginal liquidity. Okay, this is just saying how much does the AMM's reserve in the risky asset X change as a function of the change of that asset's price on the open markets. Okay? So this is where the dependence on the AMM shows up. If I had a little more time, if this looks messy, I would show you that this is literally just the area of a suitable triangle. Okay, so if I had more time, I could make this hopefully seem even simpler to you. If you specialize it to the most popular AMMs, like the XY equal K curve made popular by Uniswap, you can get this closed form expression. So once you normalize by the value, by sort of the value of the reserves of the AMM, you get, again, for this most popular AMM that's out there, you get this sigma squared over 8. Actually, it doesn't even depend on the current price. It's exactly the same accumulation of lever, no matter where the current price happens to be. And that's, such a crisp kind of prediction, you can then make sort of give very sharp advice about how to think about providing liquidity. Like if you have a pool, and suppose the daily volatility you estimate to be 5%, which would be kind of ballpark what you'd expect for ETH USDC, and if you had 0.3% trading fees, which again is sort of standard in this part of the world, then you would find as a liquidity provider, you would break even if a little over 10% of the pool's assets traded on a daily. If the volume was higher than this, you would be profitable, like there'd be more fees than the break-even point. If the volume was less than this, right, then you would be unprofitable. So it boils down to should I provide liquidity or not? It boils it down to, if you like, a volume volatility bet, a bet on how those two things connect to each other. Okay. And so this paper came out in August 2022. If you look at it, it just looks like any of our math papers, right? There's like an introduction, there's like a section 2 is the model, and there's some theorems, and there's some proofs. And like so we started giving talks about that time, and literally by the end of 2022, it's how everybody in the industry was sort of talking about this issue, adverse selection costs for LPs. So here's a couple of sort of DeFi experts just from a few weeks later, kind of saying, yes, we agree this is like the right way to think about this issue. There's lots of podcasts, even podcast series about it, all kinds of stuff. Maybe I'm most proud of like the fact that 2023, they had a list of the top DeFi memes of the year. We won. That was number 1, top DeFi meme. Still trying to figure out how to list this on my CV exactly. Any suggestions, I'm all ears. Maybe just one final minute, just some reflections. I've been working full time in this area for maybe like 3 years or so now, and it's been pretty wild. To some extent, it reminds me of the early days of algorithmic game theory, like when none of us sort of knew what we were doing. But it definitely like reminds me of just sort of how much you take for granted when you're working in a well-established field. So well-established, I would certainly put like algorithms and complexity in this category. I'd probably put like ML theory in this category also. All this stuff you take for granted, right? So just like relatively low barriers to entry in the sense there's like good textbooks you can read, there's like MOOCs you can take. The community has kind of solved what's actually kind of a hard coordination problem on just like language, like what are things even called, on like success metrics, like what makes one paper an improvement over the state of the art. Like all of these things that in the early days of an area's formation, people don't even agree on these basic things. This can be pretty frustrating actually, but that's sort of part of the deal. So working on sort of blockchains in Web3, like literally none of these are there, which on the one hand is a source of frustration. On the other hand, like from experience, I now know often this is the universe shouting at you that this is going to be viewed in hindsight as the golden age of the area, where none of the easy stuff had been done yet. So if that sounds exciting to you, I do encourage you to maybe check it out and learn a little bit more about it. So I think I'm out of time. I'll leave the summary up here, and otherwise stop for questions. Thanks very much.
I have a quick question. So the theorem that you proved for the first part of the lecture for the 3 types of IC properties, I was wondering, are there, I mean, especially for the first 2 that were for the burning coins protocol, so is it just for Ethereum, or you can also get similar results for Bitcoin? Because like in Bitcoin, the total number of coins are fixed, so it's not easy to burn things, I guess, there. So.
Oh, okay, well, I mean, you could certainly hard fork Bitcoin to swap out the transaction fee mechanism in for this one. You're right that but you're absolutely right that this is a change in the monetary policy. You are changing the inflation rate of your blockchain protocol by switching the transaction fee mechanism to this particular one. On the other hand, the inflation rate only goes down. So Ethereum actually switched from, by deploying this, it went from a 2% inflation rate to a negative 1% inflation rate. So as a currency, it's actually gone from inflationary to deflationary. That's how big the impact of this change in mechanism is. Bitcoin, you would go from, well, it depends. I mean, so how much gets burned depends on the demand, right? But Bitcoin would go from like a small inflation rate to an even smaller or possibly negative inflation rate. So it's, you certainly could do that. There's the question of like, would the community agree to sort of upgrade in this way? Bitcoin famously basically never makes any changes whatsoever. So I don't even know anyone advocating to make this change because it's just far too radical for something to do. But there's other than just sort of the community norms, there is no obstacle to Bitcoin making the same change.
So I wanted to ask about in your summary slide, in the first bullet, you described the computer in the sky as Turing-complete. I mean, I'm a bit trying to connect like the application you described of signing things in this more general notion of computation. Like, in what sense can this do? In what sense is it Turing-complete, or in what sense should I think of it in terms of doing computation as opposed to providing a specific service, which is signing things in one or another?
Yeah, no, I mean, it's a great point, right? Because I mean, in some sense, in my sort of discussion of applications, I mean, I'm in some ways radically underselling what the technology can do. Because here I'm saying, like, all of a sudden I've specialized from a general purpose computer to a computer where kind of all they can do is verify digital signatures. Not just that, presumably I want them to be able to like transfer ownership, so like replace PK with PK prime. But still, like, I'm clearly not. And then, but to be honest, like, I've kind of done this deliberately, right? Because like in my experience, when people try to talk about the applications of this, either you can go really narrow and you can just talk about like payments, and you can talk about like, banking the unbanked or this kind of stuff. That really is sort of predicated on like finance being the killer app in this technology, which I sort of disagree with that thesis. At the other extreme, you can just get very abstract and vague. You'd be like, oh, it's a general way of coordinating with arbitrary computation. And then people are like, I don't get it. Like, what does this even mean? So over time, I've kind of gravitated toward this middle ground where I feel like it just, to me, at least personally, this feels like a very fundamental thing we have not had and that we really want. Like a notion of private property for things that are digital. Like, to me, that just resonates very deeply. So I think it's, on the one hand, I think you can feel it as like big. On the other hand, it's relatively concrete compared to just talking about general computation. That said, I'll give you an example. There are projects out there that are not so much about the ownership part and are about the just sort of trusted computation part. So like, for example, like, even just, and I'm not saying, so like, people are talking about doing, ML inference, like either inference in large models or even training in some sense of large models using this as sort of part of the pipeline. Right, so it's like kind of, maybe it's like a really large model and I don't really want to do it myself on my phone, and so I want to like offload it, and then this would be kind of like a trusted computer that could sort of do it for you. I'm not saying that's necessarily how the world's going to go, but there's definitely like projects that are exploring those aspects as well. And like you say, that has nothing to do with ownership. That's just the trusted computing infrastructure part of
it. Just a question about the second part of the talk. So these kind of these notions of permissionlessness, and how robust are these to sort of packifications? So in some sense, like if I have quasi-permissionless model, but list of IDs contains almost everybody who's available and everybody who's on the list is kind of available with probability 99.99%. Is that closer to the dynamically available model, or is it still quasi-permission?
Yeah, I'd say it's somewhat robust. I mean, basically what's gonna happen is it's gonna start eating into that 1/3. So like the more people I mean, it's not, maybe not intellectually very satisfying, but it's technically, I think, kind of correct and tight, which is that, like, to the extent that you can't count on people, you have to basically assume that they're Byzantine. So it sort of eats into that budget. But I will say, I mean, this is like literally, this paper is less than 6 months old, and the number of people that have like rocked it is like definitely still in the single digits at this point. There's tremendous work to be done, just sort of probing. Like, I would love to have people challenge whether these are the right definitions or not. So either prove kind of, equivalences that sort of build support for them, or convince us that these should be modified. I would love it if sort of more people got involved in that. We gave it our best initial shot, and I think I would like it to be more of a community effort at this point. Yeah.
On like the impossibility of the, I guess dynamically, so this theorem, just wanted to clarify, like none of these individually is achievable. It's
Correct.
not
This is
like,
really 3 different impossibility results in one.
okay, it's not like choose 2 out of 3.
Correct. Like
But
if you so basically if a protocol functions even though honest participation fluctuates, it cannot be that.
Yeah.
It also cannot be that.
Great. But
Also
in the
cannot
other
be.
one, you have one protocol that achieves all 3
Correct. And this
simultaneously.
is one protocol that gets them all simultaneously. Exactly. So it's the way you would want it to be, I guess. Yeah, for matching impossibility with possibility results.
So I'm allowing questions to go on because there's a lunch, but the lunch is late, so it's a few minutes late. So I just got from Brandy, she said it's still 5 more minutes, which means I can ask a question.
Go for it.
So it feels like one kind of big general area, and I'm just wondering the extent to which there's a connection between the following problem and the things that you're describing. Is the sort of a ability to control kind of your own stuff in the world, like how people train on data that might be generated. They scrape. The extent to which, say, your papers are used in the training data of some system. You should get some compensation for the stuff that you created that was then used here. And so people being able to sort of, that kind of thing. Did you see that being related to this, or connections, or just your thoughts?
Yeah, potentially, yeah. I mean, so the question was kind of, is any of this stuff helpful for, right, so if you have ownership, so the one thing you can have is sort of ownership of your own data, and then if you can have sort of attributable data in that sense, there's the prospect of being compensated for use of it. Honestly, I think the economic problems are maybe the most severe, more than the technological ones. So a couple things. So first of all, there definitely are, I'm aware of projects that are trying to make progress on these questions. I think they're hard questions. I don't know if any of them, they may all fail, we'll see. The other thing I'll say is, like, even if I just grant you this technology working perfectly, for example, right, so like if you provide data and you're largely substitutable, right, so certainly something like the Shapley value and a lot of other ways you would try to ascribe value would give you very little, right, which I think is not what people mean when they say you want to be compensated in some sense for your data, right? And so I don't know that I've even felt like those basic economic problems have really been solved so far. Like and obviously you can sort of hope if someone's data is truly unique, then they get compensated in a meaningful way. But I'm not sure that would actually satisfy the people that would like, I'm not sure that's a solution to what people have in mind either. So yeah, so short answer is probably this technology would help, but I don't think it's the bottleneck. It's just getting a business model, if you will, of how that would work. I think it's the bottleneck for me at least. So.
All right, well, thanks, Tim.
All right.